Welcome to Griffonomics.
It's really good to be back. And today we're actually doing something a little bit different. Usually, we're looking at the next big thing before it happens. But today we are looking at a comeback story.
A massive comeback story. And honestly, a bit of a survival story if you really look at the timeline.
Yeah, that is a very fair way to put it.
Because if you were following the markets or just listening to literally any media 3 or 4 years ago, back in that, 2020, 2021 era, you probably remember Talkspace, ticker symbol TalkAI.
Oh, it was impossible to forget. They were absolutely everywhere.
Right. You couldn't turn on a YouTube video. You couldn't listen to an audio show. You couldn't even turn on the TV without seeing like Michael Phelps or Demi Lovato talking about it. They were the absolute poster child for that first wave of digital health mania.
The whole, the COVID stock era.
Exactly. But then, well, the narrative crashed. The world opened up, people went back outside, and the stock just tanked. People questioned the fundamental business model. And frankly, a lot of investors, and probably a lot of you listening right now, wrote them off as a zero. Just another pandemic darling that couldn't survive in the real world.
It was a brutal correction. I mean, the stock lost, 80, 90% of its value at one point?
It was incredibly ugly. But fast forward to today. It's February 25th, 2026. We have the full year 2025 numbers sitting right in front of us. We have the transcripts from the JP Morgan Healthcare Conference that just wrapped up last month in January. We've got a stack of investigative financial reports, and the story has completely flipped.
It really has. I mean, this isn't the same company it was in 2021. It's almost unrecognizable on a fundamental level.
So that is the mission for this deep dive. We are going to unpack how Talkspace went from burning absolute mountains of cash on Super Bowl-style ads to becoming what looks like a highly profitable B2B infrastructure play for the entire mental health industry. We're talking about a fundamental structural transformation.
Right. And to do that, we need to look at the 3 big pillars of that transformation. We are going to look at the public health AI inflection point because their AI strategy is actually quite different from the rest of the tech world. We need to talk about the TalkAI safety mode.
Which is fascinating, by the way, and I have a lot of very skeptical questions about that for later.
As you definitely should. And finally, we have to discuss the strategy of 200 million covered lives, because that is the number that just changes the entire math of the company.
Okay, so we have the Q4 and full year 2025 earnings calls that just dropped. We have the investor presentations. I want to start with just a quick vibe check. I'm looking at these numbers and I'm seeing green. I'm seeing accelerating growth. But before we get into the EBITDA and the margins, which we will, I promise, I want to set the stage on the business model itself, because I think a lot of people listening still have that old version of Talkspace in their heads.
Yeah, the text-to-therapist app.
Exactly. The direct-to-consumer app where you pay a subscription out of your own pocket to text a stranger about your problems.
Right. And look, that was the original innovation. 10, 12 years ago, that was actually revolutionary. It broke a huge stigma. But as a business model, it was deeply, deeply flawed.
I really want to pause on this because in the startup world, people throw the word pivot around. Like, it's just so easy. Oh, we just pivoted. But for a company the size of Talkspace, changing from a consumer brand to a B2B infrastructure play that is like trying to turn an aircraft carrier around in a bathtub.
It's violent. You're completely right. And to understand why they absolutely had to do it, we have to look at the math of the old Talkspace. Let's go back to 2021.
Okay, take me back.
You're seeing Michael Phelps on TV. You're hearing ads on every stream. Those ads cost a fortune. This is the customer acquisition cost, or CAC. In the old model, Talkspace had to pay Google or Facebook or TV networks massive amounts of money to convince you, specifically you, the listener, to pull out your credit card and pay $300 or $400 a month for therapy.
Which is a really hard sell. I mean, $300 is a car payment for a lot of people. It's groceries for a month.
Exactly. It's a luxury purchase for many, so they spend, say, $100 or $200 just to acquire you as a customer. You sign up. But here is the paradox of the therapy business. If it works, you leave.
Right. You feel better, you don't need it anymore, so you stop paying.
Or, conversely, if it doesn't work, you also leave because you're frustrated. So the rate at which customers quit was incredibly high. They were on this relentless treadmill. They had to burn cash constantly just to replace the people walking out the door. It was a leaky bucket.
Like a hamster wheel. You run faster and faster just to stay in the exact same place.
Precisely. So Dr. Jon Cohen comes in as CEO, this is late 2022, and he looks at this bucket, and he basically says, we aren't going to fix the leak. We're going to change the water source.
Oh, that's a great way to put it.
He realized that the person with the money wasn't the patient. It was the insurance company,
Yeah.
the payer. He decided we are going to stop trying to be a cool consumer brand. We are going to be a boring, reliable medical utility.
And boring is usually where the real money is.
Always. So instead of fighting for your credit card, they went to United Healthcare, to Cigna, to Aetna, to Premera, and they said, look, your members are depressed. They're anxious. And it's costing you, the insurance company, massive amounts of money in ER visits and lost productivity. We have the network of therapists. Let us handle it.
And that shifts the economics completely, because now you don't have to buy Facebook ads to find sick people. The insurance company literally sends them to you.
Precisely. The customer acquisition cost drops off an absolute cliff. And that brings us to where we are today, February 2026, because that massive bet actually paid off.
So let's look at the scoreboard. When we look at the revenue split right now in the Q4 2025 numbers, how much of their money is actually coming from this boring payer side?
It is the dominant engine now. It accounts for roughly 75% of their total revenue.
75%, that is a massive swing.
It's a complete inversion of the company. 3 years ago, the consumer side was king. Now the payer segment is the business. And the mechanic here is really crucial to understand. It's a fee-for-service model.
Explain that distinction for us.
So Talkspace isn't chasing subscribers in the payer model. They generally aren't getting a flat fee per member per month. They are treated exactly like a massive virtual medical clinic. When a member has a session, the insurance company pays Talkspace, just like they would pay a doctor in a physical office down the street.
But with way, way less overhead than a physical office.
Precisely. No rent, no receptionists, no electricity bills for the waiting room.
Yeah, and what about that old Talkspace? You know, the consumer side. The people paying cash out of pocket.
They are letting it wither.
Is it completely dead?
Declining by design is the exact phrase management uses on the calls. They aren't killing it outright. If you want to pay cash, they will gladly take your money. But they aren't spending marketing dollars to grow it. They are purposefully letting it shrink so it stops bleeding cash while the payer side takes over.
It's like keeping the old vintage car in the garage but driving the new, highly efficient truck to work every day.
Exactly. And this brings us to that massive number I mentioned in the intro, 200 million.
200 million covered lives. That number is just staggering when you think about the U.S. population.
It is really hard to wrap your head around.
Let's unpack that. What does that actually mean for the business? Does that mean they have 200 million active customers?
No, and that's a very key distinction. It means that for 200 million Americans, Talkspace is considered in-network.
Okay.
So if you have United Healthcare, Cigna, Aetna, or even Medicare, which is a huge recent addition we'll get to, you can likely use Talkspace and just pay your standard copay. Maybe it's $15, maybe $20. Sometimes it's literally $0.
So they have effectively removed the single biggest barrier to entry for mental health, which was cost.
Cost and access. Think about the total addressable market, or TAM. When you are a D2C app charging $300 a month, your market is basically people with high disposable income who are also struggling mentally. It's as a niche. When you are in-network for 200 million people, your market is almost everyone with a job or everyone on Medicare.
It effectively democratizes the service.
It really does. And it's not just the insurance companies, right? They have this direct-to-enterprise arm as well.
Right. I saw this in the JP Morgan report. This is the secondary B2B engine.
Yes. This is where they sign contracts directly with large entities, bypassing the insurance carrier entirely in some cases.
Like the Navy.
The Navy is a phenomenal example. They have a deal with TRICARE, which is the military health system. Enrollment there is growing month over month. And think about the fundamental need there. The military has a massive mental health crisis and a severe shortage of on-base providers. Talkspace plugs that gap instantly, securely, and privately.
But the one that really caught my eye in these reports was TeenSpace.
Ah, yes, the municipal youth programs.
I saw this in the source material. They are signing deals with major cities, New York City, Baltimore, to provide free mental health access to teenagers.
This is a fascinating development strategically. The city pays the bill out of the public health budget. The teenager gets the app on their phone for free.
This is brilliant because it positions Talkspace not just as a software vendor, but as critical public health infrastructure.
Exactly. It effectively becomes government-subsidized user acquisition.
And think about the long-term brand loyalty. If you are a 16-year-old in New York City and you use Talkspace to get through the anxiety of high school, You were going to inherently trust that brand when you were 25, enter the workforce, and have your own commercial insurance.
It builds a multi-decade pipeline. You are capturing them at the very beginning of their mental health journey.
So the strategy makes perfect sense on paper. Pivot to B2B, get insurance to pay the bill, expand the pool of eligible users to 200 million. But let's look at the actual scoreboard. It is February 2026. Did it actually work financially?
This is exactly why we are doing this deep dive today, because 2025 was the definitive inflection point.
Give me the headlines on the numbers.
Okay, let's look at the top line first. Full year 2025 revenue came in at $229 million. That is a 22% increase year over year.
Solid double-digit growth. Hard to argue with that.
It is, but if you look closer at the quarterly breakdown, the momentum is actually accelerating. This isn't just flat, steady growth. In Q2 of 2025, growth was 18%. In Q3, it was 25%. In Q4, they hit $63 million in revenue, which is a 29% jump year over year.
So the snowball is rolling faster as it goes down the hill.
Exactly. The rate of growth is increasing.
Yeah.
But as we know, revenue is vanity, profit is sanity, right? This is where the aha moment really happens for investors looking at this space.
Adjusted EBITDA.
Adjusted EBITDA. For years, this company lost money. They were famous for losing money. In Q4 2025, they posted $6.6 million in adjusted EBITDA. That is a 10.4% margin. And more importantly, that is a 147% surge compared to the exact same time last year.
Okay, let's get into the weeds here for a second. I am looking at the Q4 2025 numbers right now. Revenue is up 29%. That's great. But the profit, the adjusted EBITDA, is up 147%.
It's a massive, beautiful disconnect.
Usually, if you sell 30% more stuff, you make roughly 30% more profit. Why is their profit growing 5 times faster than their top-line sales?
This is the absolute magic of operational leverage. It is the holy grail for software and tech investors.
Break that down for us. Assume I've never taken a corporate accounting class.
Okay, imagine you run a factory that makes physical wooden chairs.
Mm-hmm.
If you want to sell 1,000 more chairs, what do you have to do?
I have to buy more wood. I have to buy more fabric. Probably to hire more guys to hammer the nails and run the machines.
Right. Your costs go up directly with your revenue. You have heavy variable costs. But Talkspace isn't a chair factory. It's a digital platform. They already built the app. They already built the complex matching algorithm. They already built the CAI-PA compliant billing system.
But the factory is finished.
The factory is finished. So adding the 200,000th patient to the platform costs them almost nothing in terms of underlying infrastructure. They don't need to write new code for that specific person. They don't need to launch a new marketing campaign to find them because the insurance company just routed the patient to them.
So that extra revenue from that new patient drops almost purely to the bottom line.
Exactly. And we see this clearly in the operating expenses. They dropped by 660 basis points to 36.7% of revenue. That is Wall Street speak for they became incredibly ruthlessly efficient. For every dollar they brought in, they spent significantly less to earn it than they did the year before.
Because they slashed the massive consumer marketing budget, they don't need to advertise to individuals anymore because the insurance companies are doing the marketing for them.
That is the ultimate beauty of the B2B model. You trade the high-risk, high-reward consumer ad spend for steady, boring, highly scalable enterprise contracts.
And looking ahead to this year,
their guidance for 2026, the year we are in right now, is projecting adjusted EBITDA to jump to between $30 million and $35 million.
So they are essentially planning to double their profit again this year.
Essentially, yes.
Yeah.
And perhaps even more important for the accounting purists out there who hate adjusted numbers. They are GAAP profitable.
Real profit, not just adjusted spreadsheet magic.
Real, actual profit. Net income of $4.8 million in Q4. They aren't just adjusted profitable anymore. They are actually making real money that they can put in the bank.
And speaking of the bank, let's look at the balance sheet. Because small cap tech companies often live or die by their cash pile, especially in volatile rate environments.
They do. And Talkspace has what analysts call a fortress balance sheet. They ended 2025 with $92.6 million in cash.
And debt?
Zero. Zero long-term debt.
Wow.
Yeah, in an environment where interest rates have been unpredictable, having no debt and nearly $100 million in the bank is a massive safety net. It gives them total optionality.
It says here in the filing they even bought back stock recently.
They did. They had enough internal confidence to buy back $17.2 million in stock. And they also acquired a company called Wisgo Health, all without putting a dent in their financial safety net. That tells you management deeply believes the public stock is undervalued.
Okay, so financially, they are exceptionally sound. They've totally turned the corner. But let's talk about the how. Because you mentioned earlier that friction used to be the enemy of this whole industry.
Friction is the enemy of all healthcare, but especially mental health.
Right. I mean, the old way of finding a therapist, it was an absolute nightmare.
It was archaic. It was actively hostile to the patient.
You get a list of names from your insurance website, which is usually a badly formatted PDF from 2018. You call 10 people on the list. 8 of them don't even answer the phone. 1 answers but says they aren't taking new patients. And the last one is taking patients but can't actually see you for 6 weeks.
It was a massive barrier that actively prevented care. People who were already depressed or anxious would just give up after the 3rd phone call.
So how has Talkspace fixed this friction with the payers? Because this brings us to section 3 of our deep dive, the technical moats.
This is the boring but revolutionary stuff.
Yeah.
Directory integrations.
Explain how that actually works for the user.
So instead of giving you a static list of phone numbers, Talkspace has integrated their software directly into the insurance company's own portal. Let's say you log into your Aetna or United Healthcare app to check a dental claim. You see a button right there that says Find a Therapist? You click it.
Okay.
Behind the scenes, that button links directly into Talkspace's scheduling system via single sign-on or SSO. You don't have to create a new account, you don't have to enter your credit card, and you definitely don't have to call anyone. You can see real-time availability of licensed therapists and book a session right there, seamlessly, inside the insurance app you already trust.
So they are embedding themselves into the digital infrastructure of the insurance company itself.
Exactly. They're becoming a native feature of the health plan. And think about what that does for customer acquisition cost.
It has to obliterate it.
It goes to near zero for those integrated users.
Yeah.
These are what we call high-intent referrals. Someone is already on their insurance site actively looking for help. Talkspace is just there with a net to catch them. The insurance company is effectively handling the marketing, the trust building, and the handoff.
That perfectly explains why the payer revenue is accelerating so fast.
Yes.
They're just catching all this high-intent traffic that used to get lost in the phone tag abyss.
And it creates a massive structural moat. Once your software is hardwired into a massive insurance portal like that, it is very, very difficult for the insurance company to rip you out.
Yeah.
You become incredibly sticky.
Speaking of seamless integrations, I saw a really interesting note in the JPM presentation about Amazon Pharmacy.
Yes. This is another pure friction reduction play.
Yeah.
If you use Talkspace for psychiatry, so not just talk therapy, but medication management, they have deeply integrated with Amazon Pharmacy.
So my psychiatrist prescribes something on the Talkspace app.
And Amazon delivers it directly to your door, fast, discreetly, and often for free. It completely closes the loop. In mental health, adherence, meaning actually taking the medication you were prescribed, is a huge, huge problem. If you remove the physical trip to the pharmacy, the anxiety of standing in line, adherence goes way up, clinical outcomes get better, and payers absolutely love that because healthy patients cost them less money.
Okay, so we have the business model pivot, we have the financial turnaround, we have the technical SSO integration. Now we need to talk about the wild card, the thing that literally everyone is buzzing about in 2026. But not just any generic AI. TalkAI.
This is where it gets really, really interesting, because for the last 2 years, we've seen a massive flood of therapy bots popping up everywhere online. You know, thin wrappers around ChatGPT that let you talk to a generic AI about your feelings.
I really want to play devil's advocate here. We're talking about artificial intelligence in mental health. We have all seen the horror story headlines over the last few years. Chatbot tells user to leave their spouse. Chatbot encourages self-harm. Generative AI hallucinates. It confidently makes things up.
It's a stochastic parrot.
Yeah.
It just predicts the next most likely word. It doesn't actually know anything.
Right. So how on earth can Talkspace, a publicly traded company with massive legal liability, put an AI in front of a suicidal teenager and sleep at night? That sounds like a catastrophic lawsuit just waiting to happen.
If they were just using generic ChatGPT off the shelf, you're 100% right, it would be grossly negligent. But this is where the data moat comes in. And I know data moat is a massive Silicon Valley buzzword right now, but in this specific case, it's actually a literal safety wall.
Explain the difference between their AI and the generic stuff.
Think about what a general LLM like ChatGPT or Gemini is trained on. The entire open internet. Reddit threads, Wikipedia, fan fiction, coding forums, toxic social media debates. It learns how to talk exactly like a human, but it absolutely does not learn how to be a clinical therapist.
Right. It learns how to win an argument on Twitter.
Exactly. Now look at what Talkspace has. They have 140 million clinical messages. But not just random messages. These are highly structured, longitudinal transcripts between licensed, vetted clinical therapists and real patients spanning over 10 years. They took those 8 billion words plus 4.3 million structured psych notes, and they fine-tuned their proprietary model.
So they essentially taught the AI, when a patient presents with this specific language, a good licensed therapist responds exactly like this.
Correct. They heavily constrained the model. They essentially taught it professional bedside manner. But honestly, even that isn't enough for public deployment, because AI is probabilistic by nature. There is always a non-zero chance it goes off the rails or misinterprets a prompt.
So what happens then? How do they prevent the disaster scenario?
The kill switch. They have a separate, distinct layer of code. Not an AI, but strict, hard-coded, rules-based logic that monitors every single conversation in real time. It is constantly scanning for 10 specific high-risk trigger areas. The moment the AI detects high-risk language hints of suicide, domestic violence, child abuse, severe self-harm, the bot is lobotomized. Instantly shut down. The AI immediately stops generating responses, and a silent instant flag is sent to a human-in-the-loop. A real, awake, clinical quality professional takes over the screen right then and there.
So the user might think they are still typing to the automated system, but suddenly a highly trained human has taken the wheel to de-escalate.
Exactly. And that rigorous safety protocol is what convinced the massive, risk-averse insurance companies to actually sign off on this. No other nimble tech startup can offer that, because no other startup has 5,000 licensed therapists already on payroll, ready to jump in at a moment's notice.
That is the real moat. It's not just the Python code, it's the license to practice medicine at scale.
It creates a demonstrably safe AI, and that allows them to confidently market it to health plans and giant employers who, as you mentioned, are terrified of liability and brand damage.
So when is this actually launching to the public?
It is currently in beta testing right now with just under 1,000 users. The full, wide market launch is officially slated for summer 2026.
And what is the go-to-market strategy for something this new?
Interestingly enough, they're starting direct-to-consumer first. Cash pay, out of pocket.
Wait, hold on. I thought we just spent the first 20 minutes establishing that D2C was dead and declining by design.
For expensive human therapy, yes. But for a scalable AI product, it is the perfect testing ground. They want to test dynamic pricing, user retention, and organic usage patterns in the wild without risking a massive enterprise contract right out of the gate. Once they have that real-world data, and more importantly, once they prove the safety model works perfectly at scale, they will flip the switch and roll it out to the enterprise and payer side.
Ah, I see. So the D2C launch is basically a revenue-generating paid beta test to build the ultimate ironclad case for the insurance companies.
Correct. And think about the incredible TAM expansion here. The total addressable market completely blows open.
Because not everyone actually wants or needs a full, intense 45-minute video therapy session.
Exactly. There are literally millions of people who visit the Talkspace website every year but bounce. They don't convert. Why? Maybe they can't afford the $20 copay. Maybe they're just too intimidated to talk to a real human being about their issues. Maybe they just need to vent about their boss at 2:00 a.m. on a Tuesday.
The classic lower intent user.
TalkAI captures all of those people. It's a lower cost, highly accessible, lower barrier entry point. It captures the massive demographic of people who are too broke or too scared for traditional clinical therapy, but still need some form of guided support.
And if they eventually realize they need more profound help,
the AI seamlessly refers them up to a human therapist on the core platform. It becomes this massive, automated, top-of-funnel feeder system for their higher-margin human business.
that is a brilliant funnel. I also saw a really weird note in the marketing section of the JPM deck about something called GEO, Generative Engine Optimization.
Yes, this is a fascinating little side note on where the whole internet is heading. We all know SEO, search engine optimization, trying to stuff keywords to rank high on Google.
Right. Keywords, backlinks, blog spam.
Well, people aren't searching on traditional Google as much anymore. They are asking AI bots directly, hey, I'm feeling really anxious about my job. What should I do?
So Talkspace is optimizing their content for that new behavior.
Yes. They have a dedicated internal team working to ensure that when you ask a bot like Gemini or ChatGPT or Claude about mental health symptoms, the AI cites Talkspace as the primary authoritative source. It is literally the marketing battleground of the future.
That is wild. It's a complete arms race for AI citation.
It absolutely is.
Okay, so we've got the AI mode established. But they aren't just doing basic talk therapy anymore. Section 5 of our deep dive is about strategic expansion verticals, because they are branching out quite a bit.
They're going both deeper and wider. High acuity is the industry term for going deeper into more serious medical territory.
Meaning treating more severe, complex conditions.
Yes, specifically medication management and clinical psychiatry. That specific business line grew 50% year over year. They have rapidly expanded their network to over 400 active prescribers. This is critically important because psychiatry is expensive and notoriously hard to find in the real world.
I know people personally who have waited 6 to 8 months just to get an intake appointment with a local psychiatrist.
Exactly, it's a bottleneck.
Yeah.
Talkspace can do it virtually, securely, within a matter of days. That is massive value for the payers. It literally keeps unstable people out of the emergency room, which saves the system millions.
And what about wider?
Social health. They recently acquired a very interesting company called Wisdo Health.
Wisdo, what exactly do they do?
They focus heavily on loneliness and structured peer support. Think specifically about the Medicare Advantage population, seniors. Chronic loneliness is a massive, quantifiable health determinant for that age group. It actually causes measurable physical decline and drives up medical costs. Wisdo builds moderated, specific communities to actively combat that isolation.
So it's kind of like a highly structured medical-grade social network.
In a way, yes.
Yeah.
And I saw something else in the filings that connects right into this. GLP-1s.
The miracle weight loss drugs.
You literally cannot have a comprehensive healthcare conversation in 2026 without mentioning Ozempic or Wegovy.
Yeah.
Yes, through the Wisdo platform acquisition, they struck a major partnership with Novo Nordisk.
The actual makers of Ozempic.
Right, to provide structured group coaching and emotional support for patients managing dramatic weight loss. Because it turns out losing 50 pounds in 6 months has a massive, often destabilizing mental health component. You deal with body dysmorphia, severe anxiety, shifting marital dynamics, changing identity.
So Talkspace is brilliantly positioning itself to be the psychological support layer for the entire global obesity drug epidemic.
That is the smart play. It's riding the biggest, most lucrative wave in pharma right now, but from the behavioral side.
It connects right back to that core infrastructure theme we talked about. They are becoming the essential plumbing for mental and emotional support, whether that's for clinical depression, senior loneliness, or managing the shock of rapid weight loss.
Exactly. They want to be the default behavioral health API for the physical healthcare system.
So let's bring it all down to the final verdict, valuation. We're looking at the stock ticker, TACLK. It is February 2026. What is the consensus from the street?
It is currently trading at roughly 2.6 times its enterprise value to projected 2026 revenue.
2.6x. Is that considered high or low in this environment?
For a software-enabled healthcare company that is growing top line at 25 to 30%, with rapidly expanding profit margins and zero debt, that is historically very, very reasonable. Often these types of high-growth SaaS or digital health companies trade at 4x, 5x, even 6x revenue. Some prominent analysts are officially calling it a small-cap growth king.
So it's a classic growth at a reasonable price scenario.
Exactly. The jar your PE play. The general consensus across the major desks is largely buy or at least hold, depending on how price-sensitive your specific fund is. But the core argument from the bulls is that the broader market hasn't fully priced in the profitability pivot yet. A lot of retail investors still think of it as the cash-burning celebrity app from 2021.
And what is the upcoming catalyst that might wake the market up?
The summer 2026 launch of TalkAI. Unquestionably. If that launch goes well, if they can actually prove they can monetize an AI agent safely at scale without a PR disaster, the valuation multiple could expand significantly and rapidly. Because then the market realizes they aren't just a tech-enabled services company. They are a true, scalable AI tech company.
That makes total sense because human services scale linearly. You have to hire a new therapist for every batch of new patients, but tech AI scales exponentially.
Precisely. If they can sell TalkAI subscriptions to millions of users, the gross margins on that software product are 80, maybe 90%. Not the 40% they get on human labor.
So bringing it all home, we have covered a massive amount of ground today.
I really have. It's a complex story.
If you had to summarize this entire deep dive for the listener who is, say, prepping for a strategy meeting tomorrow morning on the future of digital health, what are the 3 definitive takeaways?
1. The Great Pivot is officially complete. They are not trying to be a flashy consumer brand anymore. They are foundational B2B infrastructure. 2. The financials are completely real. Operational leverage has fully cooked in, and they are profitable and growing faster every single quarter. And 3, the AI moat is all about safety, not just code. They are leveraging their massive, proprietary, HIPAA-compliant dataset to build the only demonstrably safe, clinically monitored AI in the commercial market.
And they have almost $100 million in cash to sit back and defend that moat.
Exactly. It's a very strong defensive position.
Well, before we sign off, I have one last provocative thought I want to throw at you based on everything we just discussed.
Go for it. Let's hear it.
We talked heavily about TalkAI handling the maintenance work, the basic venting, the late-night anxiety attacks, the lower intent stuff.
Yeah.
If AI successfully takes over that entire foundational layer, does that actually make the licensed human therapist more valuable?
Oh, that is the billion-dollar philosophical question for the whole industry. Yeah. And honestly, I think it does.
Walk me through how so.
If you can reliably offload the routine check-ins, the scheduling, the basic emotional triage, and the simple venting to an untiring AI agent, the human therapist's calendar frees up. They can focus entirely on the deep, complex transformational work, the severe trauma work, the highly nuanced behavioral interventions, the stuff a probabilistic AI simply cannot legally or ethically touch.
So we aren't actually replacing human therapists with code. We're finally scaling them to do what they were trained to do.
We are letting them operate at the absolute top of their clinical license. It might actually be the exact moment that mental health care finally scales to meet the crushing global demand.
That is an incredibly hopeful place to leave it for you all to think about. Huge thanks to everyone for tuning in and listening to this deep dive into Talkspace. We hope you found the analysis useful.
It has been a real pleasure breaking it down.
Risk defined.
Portfolio protected.
We will see you next time.